Hello, my name is John Byrne, Principal Economist at Asian Development Bank. Welcome to this presentation of the Asian Development Outlook for September 2025. The title of our report is Growth Slows as a New Global Trade Environment Takes Shape. Let me begin by talking about some of the key messages from the report. A new global trade environment is emerging. So since August, US tariffs are at 15 to 20% for many economies in Asia and the Pacific and higher for some. Product level tariffs on semiconductors, pharmaceuticals, and other products are still being considered, while the risk of renewed escalation between the US and China remains. As well as that, the US economy is showing signs of slowing, which prompted the US Federal Reserve to cut interest rates by 25 basis points on September 17th. Against this background, the ADO September lowers growth forecasts for Asia and the Pacific by 0.1 and 0.2 percentage points compared to April to 4.8% for 2025 and 4.5% for 2026. These downgrades reflect primarily the expected impacts of higher tariffs and elevated trade uncertainty. China's forecasts remain unchanged from April, with policy measures expected to offset domestic and external challenges. India's growth outlook is downgraded to 6.5% for both 2025 and 2026 due to much steeper tariffs. Meanwhile, inflation in the region is now projected to decline further to 1.7% this year due to lower commodity prices before moving up to 2.1% next year, partly due to normalizing food prices. In terms of risks, trade risks pose the main threats to the outlook. Analysis in the report indicates that renewed US-China tariff escalations would reduce regional growth by around 0.8 percentage points this year and next year. Other risks to the outlook include financial volatility associated with market corrections, re-escalation of conflicts and geopolitical tensions, and worse than expected deterioration in China's property markets. Now, let me provide some further details. So to start, let me note that US tariffs have now settled at historically high levels. The left-hand side chart shows that the average effective US tariff rate has spiked to 17.4%, which is the highest rate since the Great Depression. It was just 2.4% in 2024. The tariff hikes were associated with soaring trade policy uncertainty. The index on the right-hand side of the chart shows that trade policy uncertainty peaked in April following the US-China tariff escalation. Uncertainty eased after trade deals were announced during May to August, but it remains elevated. This reflects lack of clarity on the implementation of trade deals and other expected tariffs, notably on semiconductors and pharmaceuticals, as I mentioned earlier. US tariffs on Asia and the Pacific rose sharply on 7th of August, though these were less than announced on the 2nd of April. The left-hand side chart shows that most major regional economies now face additional tariffs about half the rate announced in April, though this still remains a sharp increase from 2024. Some further details on that. So accounting for exemptions and sectoral tariffs, developing Asia's average effective tariff is around 30%, which is nearly twice as high as the US global effective tariff of 17%. Despite the pause until 10th of November, the PRC already faces the highest effective US tariff at around 45%, as the 30%, which can be seen on the left-hand side chart, adds the tariffs imposed between 2018 and 2024. Actual and expected tariff changes have shaped the region's exports this year. As seen on the right-hand side, developing Asia's export growth accelerated from 6.2% in the first quarter to 9.9% in the second. This was largely driven by front-loading of imports in the US, as the 2nd April tariffs were mostly capped at 10% until 7th of August. For high-income technology exporters, front-loading was reinforced by strong demand for electronics and AI-related products, Export growth in China was more moderate, with falling shipments to the US offset by rising exports to other destinations. Trade uncertainty, tariffs, and other economic developments have also started to affect the US economy, impacting policy considerations. We can see this reflected in market expectations for the federal funds rate, which have fluctuated sharply over the year. As shown in this chart, shifts in interest rate expectations since late 2024 were closely tied to major policy announcements, trade measures, and evolving macroeconomic conditions. While higher tariff rates can be associated with both lower growth and higher inflation, recessionary fears appear to have dominated. For example, the swing to lower interest rate expectations between March and May coincided with higher tariffs being imposed on Canada and Mexico and the higher tariff hikes on April 2nd. More recently, when softer labor market indicators were released on August 1st, markets reacted by pricing in faster monetary easing by the US Fed, despite persistent inflation risks. This all has implications for economies in developing Asia, which, as well as by trade policy shifts, can be affected by Fed policy changes, as also shown by economic trends that we've seen so far this year. So this slide shows recent developments in growth and inflation in the region. Now, on the left-hand side, we compare GDP growth in the first half of 2025 with the second half of 2024. The first two bars on the left show that regional growth accelerated to 5.4% this year, compared to 4.9% in the second half of last year. Net exports, shown in green, drove the acceleration, boosted by tariff-related front-loading and tech exports, particularly from China and some high-income technology exporters, as seen in the other bars. The contribution of consumption, shown in blue, was flat, as weaker consumption growth in India and the rest of developing Asia was offset by policy-driven gains in China. With the exception of India, where higher government capital spending boosted investment, the contribution of investment to regional growth, shown in orange, declined, led by weakness in the property sector in China. On the right of this slide, you can see that inflation outside of China, shown in green, fell below the pre-pandemic average of 3.2% this year, as easing food and energy inflation outweighed slightly increasing core inflation. In China, sharp declines in producer and food, particularly pork prices, resulted in mild deflation. In terms of inflation, moderating inflation across the region is creating policy space for further interest rate cuts. To make this point, the left-hand side chart shows that inflation is now below or within target, shown in the green diamonds, for 11 out of 17 inflation targeting economies. Notable exceptions are Bangladesh and Kazakhstan, where in July inflation exceeded the target by over 3 percentage points. The right-hand side chart shows that over the period January to August of this year, central banks in 11 of these inflation targeting economies lowered their policy rates. Kazakhstan, Mongolia, and the Kyrgyz Republic, where inflation remains elevated, tightened monetary policy. Looking ahead, continued disinflation and the expected easing of US monetary policy paved the way for further policy rate cuts in many Asian economies. As regards regional financial markets, these have remained resilient over the year. Monetary easing would further support financial market conditions despite uncertainty over trade and US monetary policy. These have improved since July, as I've said. As shown on the left, the region's average market-weighted return, shown in the black line, improved between the 1st of July and the 12th of September. East Asia, Southeast Asia, and Central Asia recorded gains, supported by optimism over trade negotiations in July and strong economic performance in the first half of 2025. That said, average returns in South Asia retreated, driven largely by losses in India. Many regional markets fell temporarily on 1st of August as the tariff negotiation deadline passed, but later rallied amid rising expectations of a Fed rate cut in September. Net portfolio inflows, as shown by the black line on the right-hand side chart, totaled nearly 37 billion US dollars between the 1st of July and 12th of September. Inflows remained resilient in China, shown in orange, but have recently weakened in the rest of the region, as shown in blue, weighed down by equity outflows from India. Meanwhile, since July, the US dollar, shown in the green line, has stabilized against a basket of emerging market currencies. Turning to debt, debt conditions in most of the region also paint a positive picture, with debt ratios gradually falling due to favorable growth and inflation developments. As seen on the left-hand side chart, excluding China and the financial centers of Hong Kong, Singapore, in the blue line, the average government debt to GDP ratio in developing Asia declined from its peak of 49.5% in 2020 to around 45% in 2024. That said, it remains above the pre-pandemic level of 41% in the period 2018 to 2019. In China, the debt ratio rose to 88.3% of GDP in 2024, as measured by IMF data, and 68.7% according to government data from China. And this was driven by a larger government debt stock and slowing growth of nominal GDP. While debt ratios are overall contained, debt service burdens remain a vulnerability in some economies with a high government debt to GDP ratio. On the right-hand side, we can see that elevated interest costs comprise a sizable share of fiscal deficits in economies such as Pakistan and Sri Lanka, and this highlights the importance of improved debt management, greater transparency, and accessible financing to reduce the risk of liquidity shocks turning into solvency crises. Let me now turn to our global assumptions. So the growth outlook for major advanced economies for 2025 and 2026 is revised downward from April forecasts, mainly due to higher tariffs and elevated trade uncertainty. In the US, growth forecasts are lowered to 1.7% for this year and 1.8% next year. Above target inflation and prolonged policy uncertainty are expected to weigh on private consumption and investment. The 2025 growth forecast for the euro area remains unchanged at 1.2%. For 2026, the forecast is lowered to 1.2%, reflecting weaker external demand. Japan's projections are revised down to 1.1% for 2025 due to tariff impacts on manufacturing, and to 0.6% in 2026, reflecting moderating exports and reduced fiscal support. As regards oil prices, Brent crude oil prices are expected to decline further, averaging $67 per barrel in 2025 and $57 per barrel in 2026, due to the effects of higher supply and weaker global demand. On rice prices, these are projected to ease amid favorable weather conditions and record harvests that we've seen in India. Let me now move to the regional outlook. So for developing Asia as a whole, growth forecasts are downgraded to 4.8% in 2025 and 4.5% in 2026. Higher tariffs will weigh on exports and growth, but fiscal and monetary support is expected to cushion the impact. Forecasts for East Asia are unchanged for 2025 and slightly lowered for 2026. Front-loading ahead of tariff hikes boosted growth in some economies this year, but this momentum is expected to fade as tariff hikes come into effect. South Asia and Southeast Asia's forecasts for this year and next are revised downward, also due to higher tariffs, weaker global demand, and heightened trade uncertainty. In contrast, the growth outlook for the Caucasus and Central Asia is raised for 2025 due to stronger prospects in Kazakhstan, but lowered for 2026, and this is largely due to falling hydrocarbon production in Azerbaijan. In the Pacific, the 2025 growth forecast is raised mainly on account of stronger mining output in Papua New Guinea, but the 2026 projection is lowered on expectations of moderating resource output and a weaker external environment. On inflation, this is expected to ease further to 1.7% this year, driven by lower energy and food prices, before increasing to 2.1% next year, partly due to normalizing food prices. As regards the risks that we see to the outlook, so renewed tariff and trade uncertainty escalations are the main risks that we see. While trade negotiations are still ongoing, tensions between the US and China remain unresolved. Additionally, sectoral tariffs on semiconductors and pharmaceuticals could also be introduced, and the implementation of new trade deals is still subject to a significant amount of uncertainty. Some economies could also incur steeper US duties related to transshipment and other factors. Apart from trade, we see three other key risks. First, market corrections. For example, this could be triggered by a stronger than expected US growth slowdown. This could have heightened effects on global market volatility and risk aversion, leading to tighter financial conditions. And the region could be affected through weaker trade, foreign capital outflows, currency depreciation, imported inflation. Second, we see renewed escalation in the Middle East or in Russia's war in Ukraine as a further risk. This could increase oil and food prices and disrupt supply chains. And finally, further deterioration in the property market in China could also increase default risks, for example, for property developers, dampen growth, and by extension, affect growth in the region as well. Regarding the trade risk, so this slide shows the impact of two adverse scenarios. The first assumes a re-escalation of US-China trade tensions after the truce ends on 10th of November, with both sides imposing 125% tariffs. So shown on the left-hand side chart, this would significantly dampen growth across major economies next year. In cumulative terms, over the period this year, next year, growth in the US would decline by 1.8 percentage points relative to baseline, and in China by 1.3 percentage points. Global growth would fall by 0.9 percentage points, while developing Asia, excluding China, would see a more modest decline of 0.3 percentage points. The second scenario that we look at models targeted tariffs of 100% on semiconductors and 25% on pharmaceuticals. As shown on the right-hand side chart, these would have smaller effects on major economies, but could result in modest growth declines in regional economies that are reliant on exports of these products. Now, this edition of the Asian Development Outlook also includes an analytical chapter which looks at the sensitivity of foreign capital inflows in emerging and market economies to global factors and domestic fundamentals over the period 1990 to 2024. This is a particularly topical issue given elevated uncertainty around global trade, geopolitical tensions, and also on the path of US monetary policy. On the right chart, we can see that emerging market economy capital flows have tended to run through boom-bust cycles over the past 3 decades. Easier global liquidity conditions, particularly during the US Fed's quantitative easing period from 2009 to 2014, led to surges in capital flows to emerging markets. After the end of QE in 2015, a tightening in global liquidity conditions triggered some outflows, which later recovered as investor sentiment improved. The chapter focuses on trying to understand the global and domestic drivers that are influencing foreign capital inflows to emerging markets during the most recent period in particular. Now, let me talk about some of the key findings from the chapter. So the main message from the chapter is that while emerging market capital inflows remain sensitive to global shocks, remain shaped by what happens to global liquidity conditions, strong domestic fundamentals can provide a stabilizing role. Well, looking at the top two panels, we can see that US Fed rates and trade policy uncertainty, which are shown in blue, negatively affect emerging market portfolio debt and equity inflows. On the other hand, trade openness, which is shown in orange, has a positive impact, thereby driving inflows and counteracting to some extent the negative effects of global factors. The bottom two panels show the results for cross-border loans and FDI. Here, global geopolitical risk emerges as the dominant factor affecting inflows in terms of global factors. For cross-border loans, financial development turns out to be a key offsetting factor, while GDP growth is important for driving FDI inflows. Overall, the results from the chapter indicate that robust growth prospects can boost investor confidence, while trade openness, well-developed financial markets, as well as sound institutions enhance resilience. Stronger fundamentals can help to cushion external shocks, absorb capital inflows more productively, and also make reversals less stabilizing. Let me stop here. Thank you very much.
Thank you, John, for an excellent and comprehensive presentation. Hello, everyone, and welcome again to the Asian Impact webinar for the launch of the Asian Development Outlook. The flagship report, rich in data, information, and analysis, is now available online. I am Madhavi Pandit, a senior economist in the Economics Research and Development Impact Department of the Asian Development Bank, and I will be moderating the panel discussion today. We have an esteemed panel of experts who will help us explore further the drivers of economic growth and inflation, the key risks affecting the region's outlook, and policy responses to the ongoing challenges that we face. It is my pleasure to introduce our panelists representing the various sub-regions. Yothin Jinjarak for the People's Republic of China, Aminur Rahman for the Pacific, Parvina Rakhimova for Central Asia and Caucasus, Rana Hasan for South Asia, and James Villafuerte for Southeast Asia. Just a quick word on the format. So I will kickstart this discussion with a few questions for our panelists, and the audience is invited to submit their questions in the Q&A box, or if you like any of the questions that are already in the box, please hit the thumbs up button, and I will raise as many as possible with our panelists in the next 40 minutes. Okay, so let's dive in with a question for Yothin on the PRC. Yothin, for the largest economy in the region, can you elaborate on the drivers and challenges impacting the PRC's growth trajectory?
Well, hello, Madhavi. Hello from Beijing. So thank you for the question. I think the nice presentation by John already set a very good context. And concerning China, I think we can relate the drivers and challenges of Chinese economy to what John already talks about. Now, I think when it comes to the driver,
It is frozen, Yothin.
export the Chinese economy. So up to now, first half. Hello, can you hear me?
Yeah, we lost you for 2 seconds. If you could repeat that sentence.
Right. So for China, the export remains very important for growth. We've seen that in the first half, or even for the first 7 months, the export is very strong, and it contributes to the growth so far this year. So we see the resilience of export from China into the new destinations. So we know about this trade tensions going on. But at the same time, for the first half or the first 7 months, we also seen that export growth from China to the other markets like Southeast Asia, to Africa, among others, even show very strong performance. And that strong performance of export already contribute to growth and also contribute to the robust performance of manufacturing, industrial production. So I think for the driver in the short to medium term remains to be the export. Now, in the long term, for China, we already see the big progress in China in terms of what the government calls the new quality productive forces. We are talking about sectors like AI, semiconductors, advanced manufacturing stuff. So this should be able to lead China in terms of longer term growth. Now, that also related to the challenges, because for sectors like these new sectors in the semiconductor, AI, advanced manufacturing, it depends a lot on the international trade. And as John already talks about, due to the uncertain global trade environment, we have to think about what would happen to the longer term trade performance of China. I think it's important to think about not only in terms of how much China can export, but in terms of long-term productivity of China. Because after all, now China is, if you think about the comparative advantage of China, they already start shifting from the traditional manufacturing, and now they go on into the new sectors, AI, advanced manufacturing. So this sector depends a lot on trade, export, but also technology transfer to boost the productivity and innovation. So the stable global trade and investment environment also very important to the longer term growth in China. So I would say that in the short to medium term, we can expect export to play an important role. But in the longer term, we should look at all these new sectors. But then we should think about the challenges due to the uncertain global trade environments. Maybe I pause here first, Madhavi.
Thank you, Yothin, for framing the discussion in terms of opportunities and challenges in the short, medium, and long term. Let me move to South Asia and bring Rana in. Rana, a question for you is, so the ADB expects India to continue being one of the fastest growing major economies in the world. But given the high US tariffs on Indian exports, what factors do you think will sustain India's robust growth despite these external challenges?
Thank you, Madhvi. So, as John had already noted, we have brought down our forecasts. So, for example, we were expecting back in April that the Indian economy in 2025 would grow by 6.7%. It would actually ramp up a bit to 6.8%. And now what we've done, and primarily because of the 50% US tariffs, has brought both of these forecasts down to 6.5%. And essentially, it's being driven by the fact that the affected exports, India's exports that are subject to these tariffs, account for about 1.2% of India's GDP. Now, having said that, a reader might think that, well, why isn't the impact larger? And I think the answer to that is pretty clear. There are a number of countervailing forces. So first of all, just in terms of fiscal policy and monetary policy, the government has been taking steps on the fiscal front. For example, we see that the GST rates have come down. So in fact, on September 22nd, to give you an example, automotives, various types of cars, scooters, motorcycles, which were taxed originally at 28%, they're now being taxed at 18%. And the market sentiment is quite bullish on this. We've also seen early in the year some reductions in personal income taxes. So you have a boost coming in through fiscal policy. On the monetary policy side, the Reserve Bank of India has been reducing interest rates. Some of this interest rate reduction was front-loaded, and we expect that, as the months proceed, we're actually going to see these reductions in these policy rates translate into lower interest rates in the market. On top of that, we have a very good monsoon. The monsoon actually has been 8% above the long-term average. While there has been a bit of flooding in certain areas, overall, our expectation is that this is going to dampen inflationary pressures. It's been very good for the reservoirs, etc. So you're seeing a number of bright spots. Just a bit more on the medium term, I'd also like to mention that India has actually, this whole episode has accelerated Indian policymaking in two areas. Number one, just on the trade front, what we are seeing is a renewed attention on free trade agreements. In fact, India is negotiating with the US, but it's also starting negotiations with the EU, with countries in Latin America, with countries in the Middle East. So you're seeing this thrust on free trade agreements. Number two, as you know, any observer of the Indian economy will be able to would agree on this. There's a unfinished agenda on domestic deregulation. And while this has been really on the anvil for some time, and the government has been taking steps, we clearly see a lot of acceleration on this front. This is taking place at the central government level. This is taking place at the state government level. There are moves being made to try and accelerate some of the labor reforms that have been put in place. There are some states which are taking steps to make land assembly, land acquisition easier. There are steps being taken to basically make land markets function better. And so we're hopeful that in the medium term, there's this silver lining to what we see happening. I'll stop there, Madhuri.
Thank you, Rana. And there are several questions on other South Asian economies, but I will come back to you after we do a round with the other panelists. Let me move to Southeast Asia. James, if I might bring you in. So, Southeast Asia has experienced the largest revision in the September ADO forecast. Could you elaborate on your outlook for the region's economy, especially considering global trade disruptions, inflation, and regional uncertainties as well?
Hi, good afternoon to the viewers of the ADO Launch, and thank you, Madabi, for the question. Yes, Southeast Asia has seen one of the largest downgrade in the September ADO outlook. Compared to last year, 2025 growth is expected to come in half a percentage point lower. Compared to our forecast in April, it's about 0.4 percentage point lower. But despite this, I believe the medium-term outlook for the region is robust, and it's supported by four factors. One is domestic demand remains a cornerstone of growth, and this is because of very strong policy support. For example, in the region, five economies have cut their policy rate ranging from 25 basis points to 75 basis points. Seven economies have actually adopted a combination of fiscal stimulus ranging from infrastructure investment, support to social spending. There are also improvements in labor market, and for the Philippines, remittance remain a mainstay. Tourism also continues to recover from the pandemic. And the other one is, I think, public investment remains a steady driver for growth. For the Philippines, we are investing at 5 to 6%, focusing on railways, subways, and the creation of innovative bridges. For Malaysia, the focus now is really on data centers, AI, and investment in renewable energy. For Thailand, there's really a big push on using water management and also investment in transportation. And in Vietnam, infrastructure package is still being done to support construction boom. We are also seeing a lot of sectoral diversification in the region, and these sectoral diversification, particularly in manufacturing, are creating new growth drivers. For example, Thailand is moving towards smart electronics and data centers. Vietnam is investing in logistics. As I mentioned, Malaysia's push for digital infrastructure is really quite big, and even Cambodia is moving into simple electronics. So the sectoral diversification are creating, I think, the new sources of growth for the region. For the region, inflation is also quite favorable, as mentioned by John. Weak oil and commodity prices and timely policy response has made inflation in the region quite manageable. The last thing that I'll mention probably is really the role of strong regional
coordination and cooperation, where ADB plays a big role. And this actually allows the region to boost policy coordination in response to global challenges. Back to you, Madhavi.
Thank you, James. If I might keep you on for a moment longer, there is a question in the chat box on the current trend for Philippines exports and imports. Do you see any shifts in terms of, the major trading partners?
Yeah, actually, the Philippines, in the first, I think, first 8 months, first 7 to 8 months, export growth in the Philippines has come in quite strong. And the key countries where these exports are going to, the US still a big part, China, Hong Kong, and Japan. Uh, for the US, it's mainly, I think, electronics. For Hong Kong, it's a transshipment of commodities that goes to China. uh, there's also improvement in exports to Indonesia. I think this is related to the trading in terms of critical minerals. And lastly, some improvement in exports to Korea related to industrial machinery and petrochemical. But as I think the global the trade fragmentation comes into effect, we expect that this stronger trade figure would probably weaken.
Thank you, James. Let me bring in Parvina for a question on the Caucasus and Central Asia. Um, I think it is one region that has bucked the trend. Could you elaborate on what are the drivers that growth um, keep growth momentum in this region?
Thank you very much. This is a very nice question because this is one of the regions in Asia which is growing, and for the 2025, it showed actually very nice growth performance for most of the countries. And it is expected that for 2026, the growth will continue as well for the region, but not at the same pace. In case of 2025, the key growing economies in the region were Kazakhstan and Georgia. And the main rationale for that was that in Kazakhstan, there was a growing demand, domestic demand, which boosted the growth. And then there were greater exports of the product the country was able to expand. In case of Georgia, the country emerged as a regional hub for transportation. There were increase substantial in the services provided. For example, the IT sector developed very well in Georgia. And there was also increasing numbers in terms of the tourism sector growing. There was some countries where we revised the growth forecasts down, but the economies were still growing at very nice pace. These countries were Azerbaijan, Kyrgyzstan, and Turkmenistan. Like, for example, also Kyrgyzstan, we revised the forecast for the end of the year for 25 down, but the country was absolute leader in growing in the pace of growth. It is expected that it will record about 18%, 11% growth in 2025. This to highlight the main drivers in the region, again, there is a growing domestic demand, which is boosting economies in most of the countries. Then in a number of the countries, the fiscal stimulus, which was implemented by the governments, contributed to growth. For example, in countries like Azerbaijan, Kazakhstan, and Tajikistan, the governments introduced very strong fiscal stimulus by investing into infrastructure and various social programs. So that boosted that. And another part was very interesting is that a number of countries in the region emerging as big exporters of gold. They have been benefiting from growing prices and demand on gold. These countries were Kyrgyzstan, Tajikistan, and Uzbekistan. This growing exports of gold contributed to their improved external positions and revenues. So these were the main drivers for growth, but expectations are that a number of countries are facing overheating with acceleration in inflation. This, for example, cases with Kazakhstan, where the inflation rate reached the double digits in this year and expected to grow further. So that the tightening of monetary policy is expected. And in other countries, there are also some pressures that's expected due to the volatile commodity prices and various trade tensions. But if we look at the prospects in case of the US tariffs on the region, since the basket of exports in the region is very specific, they have limited exposure to the US tariffs. So we expect that's the impact of tariffs will be small for the region. Thank you. That is all.
Thank you, Parvina, for that excellent explanation. Let me bring in Aminur for the Pacific sub-region. This is another sub-region where the growth has been revised upward. Could you explain this upward revision, and is growth expected to accelerate across all economies?
Thank you, Madhvi, for this question. So, yeah, so you are right. For the Pacific as a region, we see there is a acceleration for growth in 2025 vis-a-vis 2024. So growth increased from 3.8% in 2024 to about 4.1% in 2025. Now, the main driver for this increased growth actually comes from the growth in the from Papua New Guinea. So growth in PNG actually increased from 4% in 2024 to about 4.6% in 2025. And the factors that drove growth in PNG includes first and foremost the performance from the resource sector, particularly gold. As you know, from the world market, the gold price is actually near all-time high, and that favorably affected the growth in PNG because PNG's top export is gold, and the Porgera gold mine and its activity obviously contributed to that growth. Then, besides the gold, we also see increased production of LNG, the liquefied natural gas, and also the weather conditions also favored the cash crop growth in PNG. So it's a combination of resource and non-resource sector that help the growth in PNG. Now, in addition to PNG, we also see, increased growth in the context of FSM, a much smaller economy, and that is due to the first full year of the financial assistance under the Compact of Free Association that supported that growth. And then also in the Cook Island, we also see an increase in growth, and that is driven by the tourism sector. Now, but unfortunately, this is not the case all over the Pacific, because for a number of countries, we also see a downward revision in growth, such as in Nauru, and that was driven by delays in the infrastructure projects related to the country's hosting of the Micronesia Asian Games. Samoa actually has been facing some issues related to their, parliament, and then the budget approval and so forth and so on. And in addition, they are the agricultural output, recent electricity crisis contributed to the downward estimate of growth in Samoa. And then also in some other Pacific Island countries, we see the capacity constraint has been an issue that affected negatively the growth. So it's a combination of positives in some countries, particularly the larger ones, and then several other factors in a smaller set of countries actually gives this variation of growth within the Pacific region.
Thank you, Aminur. Let me get now to some of the audience questions. Rana, there are some questions for you on Pakistan from Muhammad Malik and Ringchan Ali. And both relate to the fact that despite the devastating floods, the growth projection for Pakistan remains unchanged. So one question is, could you elaborate on the key factors that explains the growth outlook? And the other is, what is the projected growth for large-scale sectors like manufacturing and agriculture?
Madhvi, I think that question might be for Parvina. The question on Pakistan.
Okay, if she would like to come in. In Pakistan, because of the devastating floods, the growth projection has, although despite the floods, the growth projection has remained unchanged. So could you elaborate on the key factors that explains the growth outlook, and also what happens to major sectors like manufacturing and agriculture?
So the expectations that what will happen is that it's expected that there will be some time the lag in impact of the key of the inflations on that, and so maybe that's why the projections have not been changed. But I see that's since I was focusing more on Central Asia, maybe some other colleagues can respond to that question as well.
Yeah, I think
Maybe I can
sovereign
go
credit
ahead, John.
I think sovereign credit was upgraded, and this was part of the reason why there was no change in the overall forecast. So this sort of counteracted the negative impact of the flood in terms of the growth effect.
Thank you, John. Okay, Rana, let me bring you back in. We have some questions for you on Nepal. So Nepal has just suffered a large economic and political shock. Again, ADB is expecting the economy to grow. Maybe from your view on the ground, what are some of the steps that the interim government is taking to ensure political stability and give direction for reforms?
Thanks, Madhvi. So this is one of those cases where, just as we were going to finalize our numbers, we had the civil unrest that we saw on September 8 and 9, and it's been quite a political upheaval. We now have an interim government. There was a lot of social unrest. There was a lot of destruction, and what we do see on the ground is that the private sector is still trying to take stock of what happened. Just to give you one example, tourism is an important engine of the Nepalese economy, and we saw a couple of major hotels and tourist-related infrastructure being destroyed. So the initial hit was quite severe, but when we look at the formation of the interim government, we have to say that it's been very positive. The developments have been very positive, and just in terms of our own experience on the ground, We note that the interim government is very committed to accelerating the project implementation. The work that ADB is doing. We see that they're already making a quick effort to assess the damages, refurbish the offices, replace project vehicles, really basically get back to full operational capacity. We are seeing no deviations from established priorities. Our pipeline that we were discussing is moving forward. So these are all very important and welcome signs. And it's not just a welcome sign for our own projects, but I think it reflects for the broader economy. We also see that the government is remaining pretty steadfast in its focus on conducting parliamentary elections in March 2026. There is also an effort to investigate the events of September 8, 9 civil unrest. And I think that's important from the perspective of ensuring that there's accountability and justice. Now, beyond these key objectives, what we do see again is that there are no deviations from the strategic directions that have been previously set. And I must say that there are two important elements that give us some comfort. Number one is remittances has been traditionally and even recent history tells us a very important part of the Nepal economy. The financial structures are all in place. We expect to see remittances remaining strong. Also, the macroeconomic uh, structures are pretty stable, and so we don't expect to see more than a 2 percentage point decline in the forecast that we had for GDP for fiscal year 2026. So we're thinking about a reduction from 5.1 that was noted in April to about 3% given the civil unrest we've seen. Thanks, Madhvi.
Thank you, Rana. Let me bring John in for a question on the US 10-year bond yields. Amid rising yields, what impact could it have on capital flows, exchange rate stability, and growth prospects in developing Asia this year and next?
Okay, thanks, Madhavi. Thanks a lot for this question. So something we look at in the analytical chapter in the report is how shifts in US monetary policy are likely to affect capital flows in the region. And what we find is that there's a negative relationship between shifts in US monetary policy and portfolio debt and equity flows in the region. So this would suggest that, okay, so the question is about long-term yields in this case, in other words, tightening conditions. And in the case of the US, this is clearly related to the fiscal concerns and potentially the inflation expectations that are continuing to persist in the US. But the impact would be the same in terms of it would lead to some outflows from the region, depreciating pressures. And the impact then would really depend on how central banks in the region would respond to that. So if they would respond by tightening policy themselves, this could affect the growth outlook, of course, but also dampen inflationary pressure. On the other hand, they could choose to not tighten rates in response, but that could have other effects as well. So I'll stop there. Thank you.
There is also a question on FDI flows to Malaysia being one of the highest in Southeast Asian economies. John, if you would like to take that, and I would like to then bring James in as well.
Which question is this?
FDI flows into Malaysia being quite strong.
Okay, well, perhaps James is better placed to answer that question.
James, you're on mute.
The strong investment flows that we are seeing in Malaysia is actually related to the structural restructuring in manufacturing, particularly the focus on data centers, investment in renewable energy, and also digitalization and AI. This is really, I think, the shift of the region to be more technologically and innovation driven. Thank you.
Thank you. James, there's another question where you can weigh in on, particularly because this sub-region is quite export driven. What coping strategies are countries adopting to mitigate the impact of tariffs and rising protectionism?
So I think the region has several instruments that it can use to cope with the higher reciprocal tariff. The first one is really strengthening regional integration to create a more robust regional market. And we already have the regional trade agreement, the RCEP, and we have several regional mechanisms in the region to strengthen this. The other one is really hastening structural reform to strengthen domestic supply, domestic capacity, production capacity, and supply chain. And in the region, the three major shift is actually one is adopting greater technology. The second one is focusing on investment and human capital. The other one is upgrading industrial structure through homegrown innovation. And also, the region is quite market friendly and open to really attract FDI, which brings technology and management. So, I think last but not the least, one of the coping mechanism of the region in trying to be robust to higher tariff is it maintains a very solid macroeconomic fundamental. As you know, the region has been quite adjusted to crisis and shocks in the past. So it pursues prudent fiscal and macroeconomic policies. Its exchange rate are flexible. It adopts capital flow measure. It has a very active macroeconomic surveillance, which identifies budding risks. And more recently, what we are saying is that it's going into this focus on digital connectivity, investment in sustainable and resilient infrastructure to really unlock new opportunities from greater private sector investment and growth. Back to you, Madabi.
Thank you, James. That was a question from Umair Malik. Thanks for the question. Um, Let me then go back to Rana and ask a question on Sri Lanka. So, in the case of Sri Lanka, the 2026 growth forecast appears relatively conservative. And Sheila has a question if this is something about Sri Lanka losing momentum in terms of economic reforms, or if is there a different perspective?
Thanks, Madhvi. No, in fact, Sri Lanka is not losing reform momentum. It's staged a strong economic recovery, and what's very important to note is that on a policy on the policy front, it's really remaining committed to the fiscal reforms and the IMF program more generally. In fact, we ourselves are involved in a excuse me we on reforms, structural reforms such as on trade policy reform, investment policy reforms, and we see that the new government that came in place last year remains quite committed. Now, what might have led to that question is the fact that the GDP growth rate that we've forecast is below 4%. But I must say that very recently, there's been a release of the latest, the second quarter GDP numbers. And in fact, we see these as pretty healthy. We're going to revisit these numbers. So if anything, we think growth is actually going to be better than what we have been, what we have forecast. Thank you, Madhu.
Thank you, Rana. And unfortunately, we only have time for this much today. So it brings us to the end of an interesting and stimulating discussion. A big thank you to our presenter, panelists, and audience for an excellent and energetic discussion. If you like this event, please log in to our next Asian Impact webinar titled Accelerating Asia's Growth with AI and Cloud Technologies, to be held on 18th October, Thursday, 9 to 10 a.m. Manila time, online via Zoom. Also, do check out the Asian Impact webinar webpage and the Chief Economist X account for more updates. Thank you and see you again.